Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Igor Shaltanov. He is a former professional athlete who began investing in real estate in 2015 and founded Avista Fund in 2020. They focus on raising capital from local and international investors to invest in income-generating, value-add multifamily properties. They currently serve as a limited partner in 20 deals, 20 different real estate deals, which is 3,200 plus multifamily units with a total value of over $500 million. So thank you so much for coming on the show today, Igor.
Oh, thank you, Charles. Thank you for having me. It's always a pleasure, though.
So you have a very interesting story, and I'd love to kind of break in to see exactly your personal and professional background prior to getting the real estate bug about 10 years ago.
Absolutely. So I should probably start with my pro career. So when I started to play water polo, it was actually water polo. Not a lot of people know that sport, and they kind of describe it a lot of times as that soccer was on the water, something like that. So it's just funny. And so the good thing about it, being pro athlete, like you doing what you love, you playing game, right? So you do play game, but at the same time, right? So you get money. So which is kind of a dream, right? You playing games and you get money. So, and the other side of it, and I don't know if it's a good side or bad side, it's kind of artificial world. That's what I'm always saying to the people. So because you don't get to build the businesses, right? Interact with people, drafting a lot of contracts through the years. So you kind of a little isolated. You do have a bubble of the league, right, or whatever you playing, right? That these, let's say it's NBA, for example, right? And it's usually all things around you. It's usually taken care of. All you need to do is just perform at the highest level possible, and that's exactly what I was doing, right? And then once I stopped, that was just the aha moment. It was like, oh my goodness, nobody needs like a 20 years of water polo experience, right? Nobody's going to hire me for that, right? Or so your income stream is that, like you really need to come up with something, right, which is going to be supporting your lifestyle. So, and that was a very interesting story, challenging story as well. And I think I'm going to stop here. So if you want to.
Yeah. So how did you get involved? I mean, how did you choose real estate as your investment vehicle once you transitioned out of your professional career?
I think it's a great question, Charles. There was always telling the same story. So I was maybe about 14 or 15 years old. Imagine it's a Russia, because I was born in Russia. I moved in 2010, and it was one of my friends, and we outside, right, and we just messing around as kids. And he said, "Oh, you know what? I'm gonna go pick up money." I was like, "What do you mean?" So tell me more about that. So he said, "Oh, I'm gonna pick up money. So somebody lives in our place, in our apartment, and I'm gonna pick up the money from them." I was like, "What does that mean?" So I was like, "It's like, tell me more. Like, it's what do you do with that? Like, how you do that?" And it's the first bug ever. I was not an investor, but I learned so you can actually give a place to people and they can pay you rent. I didn't know what this is called back then, so but I got that first bug. I was like, oh my god, it's possible, right? So, and that was the first introduction, I would say, of myself. I didn't take any action. I was like 14, and then I played water polo and stuff. But then maybe in 2000s, my mom saying, "Oh, you know what? We got extra apartment, and I don't know what we're gonna do with that. Maybe we'll live here and there. Maybe we'll move different places." Like, you know what? I heard you can do this, right? You can rent it to the people and get an income. I didn't know how to call it. I said you can give it to people, and they're gonna be paying you to stay in this place. And again, I'm talking about 1995 when I first time heard it. There's no YouTube channel. There's no financial books, right? It's like it's a tough. It's you on your own. You need to learn that. There's no mortgages. There's no leverages. There's no bank account. Like it's a tough. It's a different time, right? So, and then my mom saying, "Okay, you know what? We got this place." I said, "Listen, let me do this because I do have cash, right? I'm playing water polo. I receive money." So I said, "I'm going to remodel one place because we have two of them. One of them older, one of them brand new. But it's not, when you buy, there's a lot of things when you buy. There's no basic remodeling, right? It's just the concrete walls, just a simple concrete, right? What you need to do, you got to put in the money there. So you got to put the floors, you got to put tile, kitchen, and we've done it multiple times. I said, I'm going to remodel that thing. So you guys move to the new place because you deserve to. New place, it's brand new, it's just built, right? Better neighborhood, and I'm going to move the people into that old place. I'm going to remodel that one as well. So Basically, it took me about 6 months to convince them because they get used to where they live. We don't want to move. We got a beautiful park and all of that, blah, 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 emotional attachment, right? But I said, listen, once you move out and we're going to put people in place, right, you're going to be earning equivalent of your monthly salary. And that's turned her mind. So I said, that's going to be equivalent of you working 7 days, I mean, 5 days a week, right? For 4 weeks a month. You're going to be doing, and then that's completely turned her brain. Oh my goodness, really? So yes, that's possible. So, and because it's not leveraged, that's exactly what happened. So it was two students, they moved in, and this was my first ever time when I started to actually exchange the place to money.
That's quite the story. Yeah, it's a very powerful business. I mean, the recurring revenue part of it, I wouldn't say it's completely passive unless you're a passive investor, but the recurring revenue of it makes it a very, very powerful wealth building asset class.
Absolutely. Yeah, it's 100%. There's no question about it.
So, Igor, your business model is unique compared to other investors we normally have on the show. Can you describe kind of your investment strategy, criteria, and kind of what Avista Fund does?
Absolutely. The story is so from multifamily, and I heard your story as well. It's kind of similar, right? And I see it and I hear that all times and times again. So people start with single units, right? Because in it, the probably narrative is so we've been told we have a passive investing, right? Which is real estate. And when we've been told that, we bought it, right? We got into that idea, so we bought it. And then on unit 4 or 5, you really understand, so you bought another work, right? So yeah, I got full-time job, and you have another one, right? But nobody told you it's going to be a full-time
Yeah.
job. And it's like having the baby, right? Everybody say, "Oh, it's going to be so much fun. It's going to be so easy, right?" Then you're going to be, but once you get the baby, it's just your life changing drastically, right? So you got 5 minutes of fun time and 24 hours of like caregiver, right? Person. So, and that's a different perspective. The same was me. What happens is I got into 1, 2, 3, 4. So, and I understood I can't scale that model. So it's not scalable. So it pushes us to commercial real estate. We said, okay, what can we do better? How we can be really, truly passive investors, right? Not like a sold passive investors. And then, so that led us to the syndication model. So what I'm trying to say, once we enter that market of syndication, so there's a couple problems which just popped up right away. So one is, how do you find a good syndicator? How do you find the company which you can trust, right? Because if you go out on the market and everybody advertised, everybody running some ads and stuff, and again, back then it was different. Nobody was advertising, nobody was pushing anything. But now it's different. So because everybody's popping out, so the first challenge is there's no database. You don't have like it doesn't exist. You can't open the book, right? The yellow pages and say, "Oh, this is the syndicators from A to Z, and those are really good, those are bad." And so now you got to go through the journey. So we start to go through the journey. Okay, let's place a little bit of capital in each. I don't know, 50, 100,000, whatever the requirement is, and we start to really test it. So once you test it with your own money, because so once you place the capital, you start to see communication. Once you start to see communication, you start to see the problems coming up. Again, it's not all nice and clear, right? It's always going to be certain challenges. And that led us to three key points. We want to say we want to mitigate three things: management risk, so which is again the test of your own money. We said, okay, we're going to go take a journey when we're going to be actually going through this process, and we understand what the managers are doing actually when it's going to be tough times, not when it's fun and easy. When you enter into syndication, when it's a tough times, you need to refi. When the people are not paying, when you got 50% occupancy rate, those are the challenging times, and then the manager will react to that thing. The second one was always location risk, right? If everybody wants to be in Texas and not Houston, Austin, for example, right? And there's a reason to that, but also if everybody's telling you that, and again, this is me personally, you do you, right? But I don't want to be the last person in that market, right? I want to be at least maybe in the middle or somewhere like in the beginning. I want to go North Carolina. Nobody's talking about North Carolina 4 years ago, right? But not that much of the exposure to that state, right? And this is for me is location risk. And the last one was asset class risk. So multifamily, yes. Are there any other different asset classes? Yes, there are, right? Okay, let's do the storage, right? Let's do I don't know, car wash. And then we start to test, let's do the private equity, maybe organic foods. So we test it with our own capital first, and we start to understand which partners are good, right? And we didn't understand which location good, but we start to test different states. Okay, I want to be present more in states which is not exposed as much to, general narrative, right? And then for the asset class, it's just the idea of pressure. We just talked before the show, the multifamily going through, maybe it's already went through, but it's maybe still going through, right, some tough times when we face those interest rates skyrocketed and stuff like that. So, and then so the refi became very, very painful as well for a lot of syndicators, right? The debt coverage ratio like drop and stuff like that. So we want to be present in different asset classes. So this is another risk mitigation factor for us. So can we pivot real quick? Having the fund, like having the company which is focused on, for example, there's big companies which is focused on multifamily. It's great. I want to be present there with my capital. Do I want to build a company which is focused on multifamily? And again, I'm talking about myself. No, I don't. Why? Because I want to be able to pivot right away into the storage, for example, self storage, right? In the fund model, now I'm talking about why we're different. In the fund model, right, there's no brainer. You just stop the capital allocation. You're saying, okay, let's look at different partners which have already tested, and we want to be present in self storage because it's not consolidated, or because it's in Texas, right, or because it's in North Carolina, right, or South Carolina, right. I don't know, Dakotas, right, and something like that. So what I'm saying is there's a lot more wiggle room and pivot room, right? So you can make that pivot immediately, right, almost immediately, not reacting on the market, but actually kind of even maybe if you, I would say if you, I don't want to say smart enough, but maybe like if you have a long vision, right, you can pivot that before the market even actually shifts, right, or maybe a little bit right after that things. Anyways, that's my thoughts on different model, right, for the fund level.
Yeah, because there's I think there's two main like one operator type syndications that I would say would be the first one is a fund that is just for one operator, and they have we're going to buy 5 properties, 7 properties, 10 properties this year. Maybe not this year, but in a regular year, let's say they would have for a couple of years back. But the thing though is that, and then you have your single property syndication. And what you guys are doing, as I understand it, is uh, you're having a fund that is not only diversifying operators, markets, but also commercial asset classes. So it allows you guys, it allows your investors to have a lot more diversity, and also for you guys diversification throughout all different types of asset classes throughout commercial real estate.
Absolutely, yes, yes, Charles, and the example would be again, and we talked before the show, so I'm going to repeat that again. So we were so focused on multifamily because it was hot, right? And and it was the right moment, right? Because the money was so cheap, right? You can buy a really good deal. So all you need to work at, like, what's the LTV? Don't burn it too much, or don't go too thin, right? On that, on the equity inside of the deal. And once it turned, like it just turned, I would say maybe it was in like 7 to 12 months, right? This skyrocketed the APR. So, and then the operator after operator start to say, oh, we got to get capital call here, capital call there. So we cannot pay the mortgage anymore and stuff like that. So the market started to cripple down a little bit. So we said, okay, what can we do better? How we can do a different, we want to be in real estate, don't get me wrong. So the real estate, this is the general strategy, right? And that's what we do, right, every day. So but how we can be in different asset classes, and we say, okay, can we do the land entitlement? Why? And the idea was why? Because there's no leverage. Because if something uncertain, we say, okay, how we can mitigate that risk of leverage? We're going to do like full equity play. It was full equity play. We don't care what the banks are telling us because it's going to be full equity. That's one. The second one, we do shorter term. So we did 24 months for deal. And again, I'm talking about the product you roll into your investors. Would you lock yourself in the unforeseen future, which is uncertain right now, right? So the perception will be like 5 years from now, it's going to be, who knows what's going to happen, right? But when you're saying, oh, it's going to be only 24 months, to people like, oh, you know what? It's not too bad. Like 1 year passed by really quick, 2 years, like I can wait. So 18 to 24 months, a lot better, right? Perception or a lot better sell rate for investors for sure though. And then lastly, the return was 20 plus as well. Why? Because there's certain unique I would say preposition rate of our partner who was doing the deal. So in all of those things, and people say, yeah, of course we'll do that, right? So we shifted very fast, and people reacted and they said, okay, we like that. So we do understand what you guys trying to do and why you going this way. So we'll do that with you. So that's an idea.
Yeah, no, that's great. So is as I see it, like your team must review hundreds of different syndication deals. Can you shed some light on how you initially filter sponsors? I mean, obviously, you guys probably have a long checklist that we're not going to get into in the show, but I think for people that are passive investing, maybe for the first time or looking at different sponsors to actually kind of put on their short list, let's say. I mean, how are you sponsoring or filtering sponsors from ones that you will review deals from and ones that maybe aren't not ready for you and for your fund, which is kind of like the wording I hear from family offices when if a family office might tell me someone has done it for 5 years, they'll say, "Hey, come back in 5 years. We love your business model, but come back in 5 years." Obviously when you have a track record and stuff like that, and that seems kind of like how you guys do it. Can you shed a little light on kind of how you filter those sponsors and shortlist them because you're working with so many different asset classes? So I imagine it's really important to get to those best operators.
Yeah, there's a couple things. One was, and again, it's maybe general knowledge for the people, but I'm going to repeat that anyway. So the people, which is going to make a difference, and again, the people what are making the biggest difference in the deal. That's what we found out, right? Because out of 20 deals, I think there's a couple of them which just didn't perform well, but there's like two of them were complete different communication, right? The one I'm not going to say any names, but one of them like, oh, we're doing everything possible we can, and the other one we just quiet and hopefully it's gonna blow through, right? So, and you can say in the future, right? You can say, okay, what if that same problem will be 10x, right? How are you gonna react to this thing? So, and at the end of the day, it's people, right? It's a people's business, and again, some people taking that very serious and very personal as well. So we would love to bet on those horses who's like more serious and they do care about the result, right? And you can't really understand it in the beginning of the partnership, but you can understand it when you're in the middle of it, right? In the middle of the deal. So we tested the people with our own capital. So we know exactly where we're going to on the second, third time. So that's one. The people will be huge. And then the location asset class is the second. Why? Because again, the when you look at location, so and then some of them going through, for example, in California, right? So for me, it's a tough proposition to own an apartment complex in California. And again, it's just from my personal experience. I don't know, maybe because I had my own units in California and I was serving the notice of defaults and all of those things because it's on the side of the person who lives in the unit, right? It's not on your side by any means. They do not care what happens with you as an owner of this thing. So they do care what happens, and that's fine. There's different states for different people, and it's fine. But I don't want to be in that system, right? I want to be in a different location where it's more support on the landlord side. So it doesn't mean you're going to be slam landlord, but it means you protect it, right? On the legal side of deals, right? You protect it more than anything in California, for example, here, right? That's one. And then the secondly, again, the asset classes, once we choose a really good operator, not in one asset class. And again, we do want them to be hyper focused on certain, for example, multifamily. That's it. You guys super good in multifamily. Keep doing this, right? If you're super good in self storage, yes, we would love to see your track record. Number one, we would love to see employees and what the team looks like. Is again coming from the business a background, right? I know understand so what the structure of any company should look like, right? So you do have department of sales, you do have marketing, you have HR, you have this. So I want to see the team. So how many people in that team beside that principal, right? If the principal is good, let's say they qualify, right? So let's look at the team. We're going to fly into you. We're not going to connect on Zoom. We're going to fly in. So we're going to walk through the properties, right? We're going to talk to the people who live on the property, not who work in the office, who actually live in the property, because they're going to give you the best feedback on the property owner. It's not the employees who's working and biased, right? It's the people who doesn't care, right, about your company. The only thing they care how they treat it in their space where they live, in their living space. And that's a huge, for us, it's a huge feedback. So when I see people smiling on the property, when I'm walking with the property management around that, right, block, right, and everybody's smiling and they know by name property management, that's huge. That's going to make a huge difference on your success of the deal, right, in the future.
Yeah. It's also true. You get a lot of information from tenants on properties. I mean, when we've done walkthroughs, and if you're inside units and there's a tenant in there, and you're only in there for a couple minutes, but if you're asking them, hey, do you like living here? Do you like the property manager? And they're going to be completely honest with you. I mean, this isn't, they don't care. You know what I mean? And which is great. And they'll tell you, that's what I want to hear. Like, they don't fix this. This is usually a thing. They don't fix this. They don't do that. They don't. And you're like, and as an investor, you're kind of like licking your lips because you're like, okay, this is like, I can fix all this. This is just like basic property management. They've just kind of like disappeared. You know what I mean? Which happens a lot. You know what I mean? With these people, they just like kind of put it on the back burner. They don't have, they're just like using it as like a cash machine, investors. So you can come in there, do some upgrades, actually be an active property manager, landlord, and turn the property around. But that's a lot of good points on working with the operators. And when you're going more deal specific, obviously you're working in landlord friendly states. And I know exactly that. I started as a landlord in Connecticut in the Northeast, so nothing like California or New York, but close, and very tenant friendly. And but the thing though is that, can you tell us a little bit more, maybe deal specific? We can just work with like whatever asset class, say multifamily or whatever kind of things that you really look for, your team likes to see. Just a couple high level points when you're specifically looking at a deal.
So you're talking about on the property level, right?
Yeah, that's correct. So they send you, you've got a operator sponsor that you're all set with. They're on your short list, right? You like them, and you have a property that gets sent out to you. What are the first couple, where are you spending your first 15, 20 minutes? Your team, let's say, looking at it. I know what I'm looking at. What kind of stuff are you probably looking at?
And again, and it's obvious, but the basis, right? What's the price? Because again, going into the deal with a good basis, it's a lot more wiggle room, right? So you can do a lot of different things wrong, and it's still going to work. So the basis, and then how maybe opportunistic play. One of the like clear example could be, okay, we did the hotel conversion. Example would be like the COVID hit, and the occupancy rate dropped to 10%. So they want to sell it at 21 million, right? Before pre-COVID times, right? So once the COVID hit and they're going through challenging times, older owners, right? They own it for maybe about 25 years or so. That's another huge piece. If you see the building which is owned for the last 25 years was the same owner, that means they built so much equity. They're most likely to give you a good deal, whether you're just buying like after 3 years of optimizing operations. I mean, what can they give you? What type of discount they can get? What type of wiggle room they have? Nothing, zero, right? There's no skin and bone, right, to do that. So, and this is the huge piece, the basis basically, and then how long they've been ownership, the previous ownership. So, and then back to that story. So once the COVID hit, right, they were willing, they were not willing, they were begging to buy it, right? If you guys can buy for 14. So from 21 and one down to 14. Understanding market, meaning so the COVID, with all the respect, it's not going to be forever, right? We're going to go back to the times, right? And we just jump in the deal, we buy it, right? And now it's just a process of remodeling. So again, the basis for the price is huge, right? Going into the deal specific, right? We want to look at the structure. It's like, what are the year built? It's a tough to deal with 60s still, right? I mean, there's a lot of stuff could be wrong. Again, you open the walls. Oh, and the city comes in to do the inspection. Oh, you need to change electricity. Now you reinforce the structure basement. You got to do this and this. There's so much thing could be wrong. So the newer, the better. I'm not saying it's going to be 2000s, but if you got between like 80s and 2000s, that's going to be really good piece. Why? Just less work. It's just simple. Less of the risk, because we went through a couple of developments. And again, that's my personal experience. I'm not saying it's not good, but it's a tough model. It's a very tough model to make it work. There's so many moving pieces that got to align together. Yes, people do a lot of might make money right on development, but again, it's a different model. I'm not, maybe my risk tolerance not there yet, right? So I want to be a little bit more conservative. I want to see that building's existence, right? So, and not just it's been existing 20 years, like 30, 40, but not 70 years ago, right? So now you facing different challenges. You open the walls and you're like, who knows what's going to be in there? So, and your budget like multiplies by three all of a sudden, right? So this is the huge piece. And again, I'm speaking more from experience than what I'm looking at, right? What we've been looking at and where we face the biggest challenges, right? And environmental risk as well, huge. We would love to see environmental reports because those are like a small pieces, which is I would say non-visible, right? And not, it could be like intangible almost, right? So you dig down and then all of a sudden you get so huge. So having that report, extensive report is huge, right? Especially if it's in a dense area, right? Somewhere. And what else on the property level? I think I'm probably going through like the biggest pieces and liens and stuff, but it's more like a financial background of that. I think that's it. And all of a sudden, again, the less risk, the minimum of that unforeseen right risk, the minimum of that things you would, which just could be like it could explode that deal like easily.
Yeah. Yeah, that's really important what you said about the older properties. And when we're saying older, we're saying 60s and 70s, because there was a lot of construction changes in the United States that really changed and progressed between the 70s and the 80s, between the materials being used. They weren't, some of them were cheaper, and that might have gone into the even into the 80s. But I think one of the main things is that you have there's like when you're looking at a property and you start seeing that okay, has some older bones, let's just say, right? We got galvanized piping, we have this, we have that, that are going to have to be looked at. And when you're making these things, it's not that you're going to be scared away from it, but you have to have enough meat on the bone to make it sense because these aren't things that no one's going to pay you more for rent because they're something's not leaking. You know what I mean? Like the roof's not leaking or the pipes aren't. That's supposed to be something that's normally a requirement of your home. So it's really great that you're saying that because this is important so people really see what I would say, like really the bones of the property are good. And then when they're doing their comparables, then it's kind of honest because now we're talking about cosmetic finishes to raise rents. And you can't get to that point if you now have to, replumb a house or something like this or rewire stuff because you have wiring that's older or whatever it might be. So a lot of great points there.
One other like and it's again it's a very simple thing, but it works. And again, in my experience, it was working always. So it's maybe a single family idea, right? I want to be the worst apartment complex in the best neighborhood. I don't want to be like at the back because, like you said, no, for the better finish of your wall, nobody's going to pay you that rent because nobody wants to live there.
Right.
Wake up, like you're going to do beautiful remodeling, so no one is going to want to live there, right? Because it's not even decent neighborhood. So, but if you got very simple apartment complex in the best school, right, in the best school district, and you got the best mall next by, right, so people will be living there. So you do a little bit of, design. I would say a little bit of like remodel, a little bit of the finishes, right, upgrade, and that's it. It's just a bingo play, right?
Right. Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. So one thing you were is that our show has a large global listener base, and why do you feel U.S. real estate is an important asset class for international investors?
It's a great question, really good question. And again, that's speaking from personal experience as well. So, and we do speak for our investors. So, the huge piece of my investing abroad from real estate, I mean, from U.S. market, right, was, let's say, I put down $500,000 of real estate in Russia, right? So it's doing really well, but to do that, you need to convert U.S. dollar into rubles, right? Now you inherited the risk of that currency conversion. So let's say in rubles, you killing it. It's double the value, right? The rent is good, rent is coming in. So, but then once you want to exchange it back here, bring it back to United States, and you look at the exchange currency rate, and you probably make 20% all in all. So it doubled the value in Russian rubles. And again, I'm speaking from my personal experience. But then if you start to calculate in US rubles, which is stronger currency, now I'm talking for everybody, Venezuela, right? Argentina. So, and that exchange rate and currency rate risk is huge because you might be killing that in the local currency. But once you exchange for Bitcoin, for example, right? It's like dime. You Thanks God if you didn't lose the money, right? Again, because by that time, dollar, Bitcoin, like grew in the value triple or four times, right? And then, so I think that was a huge piece for me. Like, I don't want to be that in that currency risk, right? That's a currency risk, and it was economy risk. It was like a legal system risk. Do I actually protect it on the level? Okay, if I own that property, I'm leaving the U.S., right? The people come and take it from me. Can I go and file to the court? And I'm talking about for the world right now. So where's that legal system actually protecting the ownership? And U.S. market by far, it's like it's the beginning of our country, right? So we want to protect the ownership, so the owner of land, right? Owner forever. It's protected by the court system. You can always claim it, and it's going to be protected by this system. So that was huge. And again, it's very easy selling proposition. You're saying you want to diversify yourself in a stronger currency, right? In a stronger legal system, which is protected. And when you start to speak of those things, so people say, okay, I understand. Absolutely. Yes, we've just been through a 5 year cycle. We lost half of our wealth. So, because if you look at the, again, a lot of international right, countries right now, you're going abroad. So they're losing half of their wealth in the span of 5 to 10 years. And it's been like that for the last 100 years. It's accelerated right now. But if you look at the history, so you own, and you again, I calculate in the bill, you own $100. How much $100 you can buy 5 years from now for that same? I'm talking about Russian ruble because it's familiar, right, for me. So half of it, right? Again, you half of your wealth every 5 years. Do you want to be in that environment when you have? So you can't even catch up yourself, right? You can't even catch up to the point when you just break even every 5 years, right? So that's why you want to be present in the more stronger market, right? I don't know, asset class, legal system. So, and that's a huge selling proposition for people who's abroad.
When you're speaking to international investors, what are some of the most common, let's say, questions, feedback, or maybe pushback you're receiving regarding investing in US real estate? Because obviously the currency risk is something that we hear from other investors that are invest with us foreign. My first LPs was from Eastern Europe, so I know a lot about international investors. So it's one of those things that, when we're working on this, I mean, let me know kind of like what do you usually hear back when you're working with these investors?
The funny thing was like, it's too far. It's not reachable. We cannot check it. And I'm telling for them, maybe it's for good. You never know. It's not for bad. It's for good. And again, a lot of times I'm getting the funniest again. That's the funniest thing. The fact that he's saying it's too far. I was like, what does that matter? So is it too far, too close? So, but I understand people. They saying we cannot control it. But basically, what they saying underneath the water, they saying we have no control. And the thing, like, we've taken the risk, and we don't feel like comfortable. We can just jump on a plane and fly and fight for ourselves, right? Because they have a perception of their own system.
Right.
And this is the biggest concern by far. So it's too far. I don't know. I'm not familiar.
And it's a wise thing. If you're not familiar with an investment or an asset class, don't invest. You know what I mean? You have to be educated, because that's when mistakes happen. When you hear people that have lost money, if they'll tell you about it, and usually there's a recurring theme, which is really just that they didn't understand it, or if you ask them any kind of question about it, they didn't understand even the details of it. You know what I mean? So it makes perfect sense. I understand totally. What do you think? One of my things is that always asking people that have had experience in real estate for a decade or so, and kind of when you look back now, I mean, what are common mistakes that you see real estate investors make? I imagine maybe you made them yourself or that you see people consistently make it. I mean, after 10 years, you see a lot of deals. Obviously, you guys are seeing tons of deals in all different asset classes. Are there any kind of things that you're seeing that are common mistakes that investors make?
Absolutely. I mean, again, I'll speak from I'm more comfortable speaking from my personal experience than from other people. So there's a couple things. One is the funny story. So people probably more reaching out to us to place capital than we reaching out to them right now. And I think this is the cycle of your business when you just establish your name, establish rate, and then all of a sudden people reaching out to you more than you reaching out to them. That's one. The second one is my personal experience was if I would focus more on real estate early enough, right? I wouldn't be testing all the different, because again, having your business, right? The business itself, amazing model, right? There are a lot more people who became a millionaires by running the business or opening the business or, innovating the business and stuff like technology. So, but then at the same time, the failure rate for that thing is 60%. Let's put it down. 50% within the 5 years will die out. So every a second business in America will die in 5 years. So can you talk about real estate like that? Every second building in the United States and the real estate investment will disappear. No way, right? You might lose a certain principal amount. You might, again, if you're going to get unlucky or if you're going to get in a bad deal. So, but for me, it was clear enough after 5 years of finding the secret investment tool, right? Finding if I would focus early, right, on real estate and real estate only, different application, different asset classes, you name it. There's thousands way to make money in real estate. Thousands, like literally, right? It could be lender, it could be this, appraisal, you name it. So if I focus on that one thing early, not looking for different shiny objects, I will be in a different spot right now. Because for me, it was, oh, it's working, but maybe I'm going to find something else. It's going to be more sexy, more appealing, more return, more this. You know what I mean?
Easier.
Yeah, it's more easier. Like you're right. Yeah, it's more, it's more trendy. People talking about that. So you just focus on one thing, stick to it, right? And the one thing I learned as well, and that's my personal experience, it's not get rich quick, but it's get rich for sure. It means it's going to take you a lot more time. But if you're not going to quit, there's going to be the same level of success. You're going to get to whatever you want to do, right, in your life if you're going to stick to that model, right? But you need to stick. It's not easy, right? It might be super profitable one day and very disappointing another day. But again, if you stick for long enough and you start early, and you're not going to be, and I'm talking about myself, I'm probably telling my younger self, and you're not going to be jumping in different directions, right? So you're going to be in better off place, right, today.
Well, that's a great way to lead off the show. So how can our listeners learn more about you and your business, Igor?
Oh, yes. It's a very simple, right? They can go to the website. It's avistafund.com. They can download the book, winrealestategame.com. Again, I played sports. I love that terminology, winrealestategame.com. Download ebook, learn more about syndications, or they can shoot me email, igor@avistafund.com. Very simple.
Well, thank you so much for coming on today, and we'll put all those links in the show notes, and looking forward to connecting with you here in the near future.
Thank you, Charles. It was a pleasure. Absolute pleasure speaking with you.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.